In this video, we're going to talk about IPOs and what it means when a company goes public. So an IPO stands for Initial Public Offering. In other words, this is the first time that a company's stock is available for the general public to buy on a stock exchange. Instead of IPO, you may sometimes just hear people saying that a company is going public. But what does that mean? So to understand this in the context of what we're talking about, a company can either be private or public. What determines that? Let's bring this into a scenario where you are the company owner and you have a company called Snow Cone that sells, well, snow cones. You probably started your snow cone stand alone. You likely took your own money to buy the actual stands and any other supplies that you needed to get this business up and running. Your company is doing well. You open up stands across your city and even a few brick and mortar locations. But you get to the point where your snow cone stands are basically the new Starbucks of your city. Everyone goes there, but you want to expand even further outside of your own city. However, you don't have the funds to do so. So what you would need to do is to actually start raising money for your company. The first place you may start is by asking friends or family or people that you work with. Maybe you even know some random outside people or investors who want to be involved, or maybe you even take your business and go on Shark Tank. You may have heard terms before like seed or angel investing, venture capitalists, and private equity firms. This is where those group of people potentially come in. These are very simply just groups of people who want to be early investors in your company. And typically what would happen is that they would give you money, and in exchange for that, you would give them part equity or ownership in the company. Again, going back to Shark Tank, that's exactly what we see on there. We would consider these people private investors. They want to put their own money into your company because they want to see it grow, and they eventually want to be able to make a return on their money if your company does really well, makes a lot of revenue, and increases in value. That increases the value of their shares as well, of the equity that they have in your company. And so it's beneficial to them to get in as early as they can so that they can see the maximum amount of return. So this is how a lot of big businesses start out, but even at this point, your company Snow Cone is still considered private. Even though you may have some random outside investors helping you out, these are individual people or individual firms that are coming to you directly. So we still consider these people as private investors. So at this point, it is just you and those private investors. Your neighbor can't go on Yahoo Finance and look up Snow Cone's stock price because it isn't there. Likewise, you can't go and just like randomly list your company on the New York Stock Exchange because that's not how it works. You're a private company. But if your company is growing fast enough, you may need to raise more money than what these private investors can give you in order for you to be able to expand and to keep growing the business. This is where an IPO comes in. By making your company available for the public to invest in, this allows you the potential to raise a lot of money. And when you choose to do that and you choose to start the IPO process, this is when we say that a company is going public. So in order to get Snow Cone to the point where it is listed on the New York Stock Exchange, where you or your neighbor can go and look it up on Robinhood, that is where we have to go through the IPO process, or an initial public offering. This usually starts with an investment bank, and there are a few things that the investment bank is going to determine. They're going to make sure you're legitimate. They're going to check financial statements, assets, things like that for your company. They're going to check up on your management, and they are going to give your company a valuation. In other words, how much they think your company is actually worth. Then you're going to determine how much of the company you are going to make available to the public to buy. In other words, this is how much of the company that you are actually giving up ownership of. So maybe you come to the agreement that you are going to give up 30% of the company, which let's say is worth $1 million. The next step is to determine how many shares make up that $1 million, and that will determine what price those shares are actually at. So for example, if you split that $1 million into 100,000 shares, that means that you would have 100,000 shares available at $10 a piece. So the investment bank will then essentially buy those 100,000 shares from you at a set price. This whole process is called underwriting. But in addition to the things that we just talked about, it's also the investment bank's job to get your company company filed with the SEC, get you listed on a stock exchange, and to actually distribute those shares that they bought from you. This usually requires a roadshow, or essentially going around and pitching or promoting your company to different groups of investors. So basically, they're going to help you market your stock and generate interest in it from different firms, brokerages, investors, etc. This is the point before an IPO happens, when you hear a lot of hype about the company. Now, the company themselves are actually usually limited on what they can share with the general public during this whole process, but there is a lot of speculation that goes on during this time, so you may still hear a lot about this company and their process of going public. Now, during this process, before it's actually available to the general public, the investment bank is going to be sharing this around with different institutions and investors. These institutions and investors are able to submit an IOI, or an indication of interest. This isn't a binding contract or anything. It's essentially them just saying, hey, yeah, I'd buy that. A normal person like you or me usually cannot get access to a company that is going through the IPO process that early on. We have to wait even longer until it's actually listed on the stock exchange and available for retail investors or people like you and me to buy through TD Ameritrade or Fidelity or Robinhood or any of your normal brokerages. This is one of the reasons why IPOs can sometimes be considered risky, because many times by the time the stock actually is available for the general public to buy, there's a good chance that it might be overpriced. And in The Intelligent Investor, which is a famous book, they have famously said that IPO really stands for it's probably overpriced. And of course, this isn't always the case, but it is the investment bank's goal to sell those shares for more than what they bought it from the company for. So in this case, with your company Snow Cone, when that investment bank bought those shares from you for $1 million, when they turn around and they are selling those shares to the investors and to the public, they want those shares to be valued at more than $1 million. That way they are able to make money off of it as well. They obviously want to make money. The company obviously wants to make money. So that's something just to stay aware of. When a company first goes public, there is a chance that that stock price is going to be overpriced. A lot of that stock's initial movement can be based on hype and speculation rather than the fundamentals and performance of the company. Also, keep in mind that a company chooses when they go public. So they are obviously going to choose the time that they think is best when they can get the most money for it. Going public during the middle of a recession or a depression, probably not a good idea. Going public now when the stock market is going up and it looks like it's never gonna stop, yeah, that seems like a pretty good time to try to go public. So with IPOs, what actually happens once the company does go public? Well, you may see some of the company's owners and employees selling their shares to cash out, and you may see the same with some of those early investors. People either do this to cash out a little bit, take some of their money, make a little bit of a profit, or they may be exiting the company completely. If you had gone on Shark Tank with your company and Mark Cuban became an investor in your company Snow Cone, at this point, after the company has gone public, he may decide that he's been helping you out for a while, but it's time for him to not be involved anymore, so he wants out completely. When you go public, he may decide that he wants to take his profits, he's going to sell all of his shares and leave the company. In actuality, the process is a bit more complicated than that, but that's the basics of it. If you are employed at a startup and as part of your compensation, they give you shares of their private company, if that company ever goes public, that could be a fantastic payday for you. So think of people who started working at Amazon or Tesla really early on and got some shares of the company as they stayed in the company longer, and that was just part of their pay. Well, now those shares are probably worth a lot more than they were when they just started at the company. This is also why a lot of high net worth individuals choose to get into angel investing. They want to be in some of those first rounds of investors that put money into these companies. That way they have the maximum potential to actually make a profit if these companies ever choose to go public in the future. What actually happens to the price of stocks when a company goes public? Well, it's hard to say. Some see a very steep increase in price and an equally steep decline. Some level off, some don't see very volatile movement at all, and some just decline forever. It really just depends on the company. There's no one-fits-all situation, so you really do have to know the background of that specific company. But what's getting interesting about the IPO space is that there are now ways for companies to actually get around going through this traditional IPO process. They do this through something called a SPAC. If you want to learn what a SPAC is and how it works, click on this video where I explain why SPACs are becoming so popular and how companies are avoiding the traditional IPO process. And I will see you guys over there.